Okay, well, as it's the last session of the day, all the way in the corner of the convention center, let's get started. We have a good panel today. We got Ken from the IFC, we have James from Hospitality Property Fund, Bevan from Grit, and Alexi, always fashionably late from Accor. If you'll excuse me, I've been sitting all day, so I'm going to stand and ask a few questions to the panel. But really the focus of today's session is to talk about the hotel sector. A particularly interesting time at the moment in the hotel space, with Africa having seen a lot of new hotel development during the past 5 years. A lot of the markets are relatively saturated, especially here in South Africa. We've seen some interesting disruptors. One of them has actually just been under discussion next door in terms of capital for Mark, as well as the likes of Signature Lux that's come in. So quite a few things to unpack with the panel. In terms of what we're going to be talking about, we want to talk a little bit about the performance of the hotel sector, so how that's going in the region. We want to look a little bit at how the opportunities are looking at the moment across the region, as well as looking at deal structure and investment returns. So hopefully we can keep it fairly lively. There's lots of time to take questions from the floor, so please do feel free to put your hand up as and when you've got some questions on the topics at hand. Good, so perhaps just to get us started, if we can talk a little bit about hotel performance, which is kind of where it all starts before the structuring, the management agreements, etc. James, you guys now have 56 odd hotels in the country? 53, okay, so maybe a few more to come in the near future. But you've got a pretty good view of what's happening in South Africa. Where's the hotel sector at the moment? How are you seeing performance?
Thanks, Sander. Yeah, it's been a difficult last 6 to 12 months in this economy. I suppose it's best to look at it in regions. In terms of the Western Cape, it's obviously been very difficult for a number of different reasons, being some new supply coming online, as well as the impact from the drought, which has impacted trading. So obviously the foreign demand has sort of tapered, as well as local travel, and then with that increased supply, it has really affected trading there. Across the rest of the country, well, Gauteng, it's been fairly flat in terms of both rate and occupancy. We've noticed in our hotels outside, what we call it rest of South Africa, outside of the Western Cape and Gauteng, that there has been actually a slight increase in occupancy, which has been driven by government demand, but very little increase in rates. So yeah, it's been a tough trading environment. Operators have had to be creative, and we probably see at least another 6 to 12 months of reasonably difficult times, and then hopefully things will recover as the economy does.
Okay, great. Yeah, and I guess in South Africa, you've also seen a fair amount of new supply come in. And like you said, in Cape Town, of course, there's been the drought challenge, but not to forget that there's been more than 1,000 rooms that opened in the last 12 months, and you've got a few more projects coming in. So I'm sure that's put a bit of pressure on trading, and economic outlook, I guess, will be important to see how demand grows. Bevan, you guys are quite exposed to the Indian Ocean resort market, which has probably been one of the strongest markets for the last 5 or 6 years. How's that going?
Correct. So we continue to see high occupancy increases in tourist arrivals to the Indian Ocean regions. We are also seeing quite a lot of transaction opportunities and liquidity in the actual underlying markets, and I think that's driven by the good numbers that are coming through the actual trading operations. I think the lift of the moratorium from development in Mauritius has also seen some new players and opportunities entering into that space. But in whole, it's very positive. It's going through strength to strength.
Great, and a good outlook as well with relatively low supply on the horizon, right? So hopefully that variable rent will continue to tick in for you guys.
Correct.
Alexi, you're a bit more focused on the rest of the continent rather than South Africa and Indian Ocean. What's Accor seeing in terms of trading performance?
I think if we look at the African continent and sub-Saharan Africa in particular, we can see. Okay. Overall, I think we can observe a decline in terms of global performances of the market in terms of both average price and occupancy, so RevPAR. Various factors depending on the countries. Nigeria has been through difficult years, so it's linked to the decrease, of course, of raw materials prices on the one hand. Can be political for some other countries. I think Kenya has had a challenging year last year because of the elections. Tanzania, with the change of government, I think there's less interest from foreign investors, which impacts the hotel market. Ethiopia has been historically trading relatively well, but of course, the recent, not going to call that political instability, but challenges within the country have had an impact. Despite that, I think some markets are still performing quite well. Ghana is one of them. Senegal is one of them. I think it's interesting to note that these two countries are characterized by relatively good political stability, which I guess is something important in Africa in order to avoid what we tend to see quite often, with elections coming every 5 years, with drops of international travelers to these markets, when some elections are coming. So overall, I think let's hope we've hit a bottom. I'll be curious to get your views on that, Xander. Let's hope we've reached a bottom and that things should improve in the next few years. I think Nigeria is, for example, going in the right direction now. I've seen some positive numbers also coming from Mozambique, and I guess that, for example, in Tanzania, things will improve in the short term.
Yeah, great point. Especially East Africa has been under a bit of pressure with all the new rooms coming in, but demand growth fundamentals are still pretty strong. It's just we're having to cope with quite a lot of new room absorption.
Yeah, exactly. That's another point. I think Nairobi is often presented as being one example of a city where there's been too much supply coming in at the same time, and reality is that fundamentally, if you look at the mid-long-term perspective, I think there's remains potential for the hotel markets to perform well in the future, just because most of these markets are backed by economies that generate between 5 and 7% of GDP growth. Reality is, of course, when too much supply is coming at the wrong time, it impacts short-term performances. So maybe to finish on this, I think sometimes it's a bit complicated to read Africa, because if you look at the statistics, you will see markets that in terms of occupancy would be much lower than the Middle East, than Dubai, than Asia, than Europe. But on the other hand, with a lot of interest, and I think that's clearly justified by the fundamental growth of that everybody forecasts for the continent. Yeah.
For sure, and I guess as Accor, you've got 160 something hotels on the continent.
You know what? It changes all the time, just because we've been quite active in acquisitions lately. I don't know. I think the last figure is maybe 120, 130 if we include Mentis and Movenpick that was closed last week.
Okay.
As many of you know, very big footprint in North Africa and West Africa, and hopefully increasing footprint on the rest of the continent. Yeah.
Exactly. Yeah, I was going to comment because West Africa, North Africa, generally speaking, have had a really good start to the year, right? So in terms of Accor's exposure, I'm sure you've had some really good trading in that part of the world as well.
Indeed, yeah.
Good. Maybe just talking a little bit about opportunities, because I think the general sense is in a lot of the continent it is muted demand as a result of high supply growth. But can maybe from an IFC perspective, give us a little bit of maybe a flavor for your mandate in terms of getting into hotels, and given where we are in the cycle, what are the type of projects that you want to see on your desk?
So from an IFC perspective, we're at a very different vantage point from my colleagues on the stage, in that we are providers of long-term capital to the hotel sector. In terms of our priorities, we look primarily to serve business hotels. We see the opportunity to build a significant, what we call business infrastructure. So business hotels in primary cities, secondary cities. We primarily are doing debt as opposed to equity. We do feel there's a lot of need for equity investments. Our reason for doing more debt than equity is that the investment horizons for hotels in Africa must be very long, and requires, so equity investors will get returns from both capital appreciation as well as, the income stream. Hotels take a long time to build and reach a steady state, so we often see the need for projects that are backed by strong operators, management contracts with reputable companies. So we're moving more and more towards supporting projects that are backed by leading branded hotels. That's a big part of our mandate.
Okay, great. And as an impact investor, I guess in a way you're looking to go into cities and countries perhaps where others won't?
Well, I'd say more places that are underserved. So underserved in the sense that where there is significant gap between supply and demand. We're doing quite a bit in Francophone Africa. I mean, we're seeing opportunities in Francophone West Africa especially. But it's not really just for impact. It's while having said that, impact is important because our experience is that for every dollar spent in direct hospitality, it's a multiplier effect of about 7 times. So it has a big, if you think about it, hotels that are built they require everything from supplies, supply chain. So you have all these ancillary businesses that support hotels, construction, food and beverage, the conferencing, security. So it has a significant multiplier effect.
Okay, great. So you're active in the sector and certainly looking to expand your exposure in Africa. That's great.
Very much so. In fact, our latest project is a Hilton Garden in Luanda that we're going to be supporting. So we see opportunities across the continent.
Excellent. James, I think you guys, once you've completed your current transaction, which is not a small size of around about 23 billion rands, if I'm not mistaken. You're going to be sort of somewhere around about the 5th or 6th largest REIT in South Africa. What's next for you guys? There's not a huge amount of hotels still to mop up and put into your fund.
Yeah, it's an interesting one, and one that I sort of can't disclose too much on at this point in time. But this transaction will allow HBF as a fund to do a lot more. Our strategy may change in time with the view possibly looking at other things, but that hasn't been finalized. So post this potential transaction will still be leisure and hospitality focused with predominantly hotels and the casino assets. But yeah, that may change in time. With the unbundling, it'll obviously assist the fund with liquidity and a whole lot of other pluses, but we'll have to take one step at a time.
I mean, from a sector perspective, I think it shouldn't be underestimated how important it is that HBF is going to be such a big and well-respected and liquid REIT, where it's probably going to be one of the largest hotel REITs outside of the US. And the fact that it's going to have a lot of institutional investor following and that they're going to become increasingly comfortable with the hotel sector should be positive overall. So that's really good.
Yeah, it's definitely going to be good for the hotel sector as a whole. It'll bring to a lot of investors' attention, and it'll get them to understand the hotel model and the variations of the hotel models, which will be good for the sector as a whole, definitely.
Great. And Alexi, speaking of big checks to write, okay, it's not 23 billion rands, which is an even bigger check. But you guys recently announced a partnership with Katara out of Qatar to deploy about $1 billion into the hotel sector in Africa. Give us a bit of flavor to why Accor went about doing that, what the investment aims are of the fund.
Yeah, okay. No, indeed, I'm sure a lot of people have seen this major announcement, or at least we have seen a lot of interest from a lot of parties actually following that announcement. I think what makes maybe Accor a bit different from some other operators is that we've moved into an asset-light model quite lately because we've sold most of our real estate a year ago. But Accor has always had this, historically has always had this hat of being a hotel investor and an operator with quite a strong track record into investing into projects. And the reality is that in many parts of the world where today we are a clear global leader, this has been possible because we've taken some risk at the beginning and we've invested. Brazil is often an example being given as such. So the view for Africa, there's a big focus for Accor Hotels in Africa, mainly to work on having a global presence because our presence is too much focused on Northern and West Africa as we speak. And the reality is that we believe that one way to be able to do that and to grow faster than competitors in terms of growing the continent is to allocate capital, because and also why allocating capital in Africa, because we do see that I would say two maybe of the main reasons why in Africa projects tend to take much more time to be developed and to be delivered. One of them is, of course, access to financing and access to decent financing at decent conditions in terms of, for example, bank debt. And the other one is sometimes the lack of expertise and professionalism of the partners. So observing that, we believe that that's where we need to focus our efforts.
So we're actually hearing it correctly that an international hotel operator is investing in hotels themselves?
Sorry?
We're actually hearing correctly that an international hotel investor is investing in hotels.
No,
This
exactly.
is
I mean,
exciting
there's often the debates, with investors that have the impression that they're taking all the risk and we're just here to get some upside. It's the same with some banks. I'm looking at you, but I was a banker 2 years ago, so I know it feels like. No, it's true. I think it's just a question of it's two different business models, and that's how we need to look at it. Being a hotel investor and being a hotel operator it's just not the same business model. So at some point you're not going to ask your cleaning lady to repair your car. I don't know if that's the best example, but that's the one that crosses my mind. Anyway, but the reality is that we're something that we're happy to do. We're happy to do. I mean, we do it with a third-party vehicle, and Accor itself will remain an operator. But definitely, we see value in doing it. Yeah.
Okay, great. Well, I guess we'll watch that space, see how that develops in terms of, for investors in the room, whether that opens up opportunities for JVs or operators, etc. So, great. Bevan, you're kind of the odd one here in terms of being a relatively institutional type of investor who, generally speaking, other than James, don't touch hotels. Just tell us a little bit about, what your investment strategy is and how Grit is able to take hotel sector or leisure sector risk.
Thank you for pointing out that I'm the odd one on stage. So going back to Grit's fundamental model is that we operate exactly like a REIT, even though we're not a REIT. Our dividend yield to our investors is 8.5%. So the way that we look at structuring our deals into the hospitality space, which currently takes up about 24% of our portfolio, is ultimately what strength of return and what rate of return can we get for our shareholders. With that said, I'm sure everybody in the room can appreciate that the risk exposure between a management contract and a fixed lease with the OpCo is very different. A fixed lease is not sexy, but that's not necessarily what we're trying to position back to our shareholders. So we will take indirect hospitality risk through a fixed lease contract with a strong operator, normally typically underpinned by a group parent balance sheet. Lease is structured around a triple net lease. We don't get too involved in the ongoing operations of the hotel and the asset itself. Where we really, the space that we play is enhancing the return to our shareholders through structuring of the tax efficiencies, the inclusion of debt. Again, because of the risk profile of a lease versus a management company, we're able to gear our acquisitions 50% at sometimes very low gearing in Mauritius. We gear our assets at 3.75% in euros. We were doing the deals at 8%. So from an equity return, it creates a very good return profile for us.
Great. So another myth squashed, that there are leases in the hotel sector and operators invest. So fantastic. Good.
Like 1 or 2 leases isn't a lot.
And I guess where you're different to Ken, aside from where you play in the capital stack, is that as by the nature of resorts and their ability to have longer lead times for businesses, for guest bookings, etc., they're in a position to be able to offer your lease more regularly than business hotels. So your focus in the short term is more on resorts than on business hotels?
So opportunistically, we have the 100% of our assets held in the leisure space. From our perspective, we would quite happily invest into business hotels. Again, where we've seen the desire to do a lease structure is whereby a counterparty needs some sort of capital injection. I know some of the larger operators have started going into an asset-light strategy that's also provided opportunities for us to pick up, but it's typically attached to some sort of capital injection, capital plan for the operators. We would adopt the exact same approach with a business hotel. Obviously, provided that it met the kind of key trading and counterparty cash flow requirements that we would have, would very happily look at business hotels. Like I say, it's just the opportunities that have come across our desk, and interesting enough, continue to come across our desk are in the leisure space.
Okay, interesting. And you take a minority or a majority position in a case where you are putting your capital in effectively for some sort of refurb or redevelopment or similar?
Correct. We do have a minority stake with New Mauritius Hotels in Beachcomber Hospitality Investments. It's a structure that's worked very well for ourselves. Obviously, there was a courtship period before we signed the lease and the deal to make sure that we can be partners for at least the next 15 years, which is the duration of the lease. But that's a model that's worked very well for ourselves. The efficiencies through partnering on 3 assets, whether they're worth $200 million, has worked out very well for ourselves.
Okay, great. Maybe just moving on a bit to operating structure, and from a real estate investment point of view, maybe Alexis, there's this very annoying thing in the hotel sector called management agreements, right? Which has a quite emotional sort of view within the real estate sector around risk-reward balance, etc. Maybe before we ask, Ken and some of the investors on their view on it, give us an understanding of why hotel management agreements make a lot of sense in the sector.
As opposed to what? Because, they make sense. It makes, for me, there's two questions. If you're a hotel investor, you have 2 options. Either you go on your own with your own brand, or you basically give the mandate to a third-party operator like us or like Hilton, who has expertise to do that, to do it on your behalf. So if that's the question, why, I believe people should come at us. I'm not saying it's always the right decision. I think it depends on the market, on the asset and all this. But just because we're providing, bringing some value in terms of our capacity to manage the hotel, and that's something that is proven. Otherwise, our business model would be dying. So I don't know if that was a question as opposed to.
I guess most investors would prefer for you to come in with a lease. That's certainly what they're most used to in the other asset classes. Is that a model that works in the hotel sector? Is that something that, as an operator, you take on?
I'm not an expert in leases, but that's something Accor, is not doing anymore for various reasons. One of them, when we were investor and when we were taking, because if you sign a lease in the end, of course you're still asset light, but you're still taking a hotel investor's approach, which again, as I said, is a different model to the hotel operating model. When we used to be hotel investors, our strategy was to go for asset heavy and invest into assets just because we didn't have any balance sheet constraints, and we just found the model to be more flexible. Yeah. But maybe coming back, sorry, I just want to raise a point around, because I know people often blame hotel operators not to take any risk, but if I look at, and I would like to understand, it's a question, and it's not just to understand a bit better your business model, because I've seen a lot of property developers saying, well, of course we would love to sign a lease with Accor, just because they see us, and with of course a recourse to the holding company, they see us as having deep pockets, and they know they will have the risk of not being paid on the lease is super low. What risk are you really taking? Unless when you're taking development risk, but in terms of real risk on the assets, when you have a good signature, what's in the end the real risk taken? I mean,
well, that's exactly why the lease is, I suppose, the preferred model from a real estate perspective, like ourselves, because the way that we would typically view a fixed lease structure, that obviously there's a fixed and variable lease element whereby we would absorb some of the risk,
but on the fixed lease,
pure fixed,
backed by someone that has deep pockets, good credit quality,
100%. We view it as exactly the same as a financing structure for 15 years. Okay. We're giving you a solution at, realizing, having a liquidity exit capital event for yourself on a sale and leaseback basis, funded off a 7.5%, 8% interest for the next 15 years. In some of these markets, that would be lower than the debt rate that you could get. In some markets, it will be higher, but of course, balance sheet restraints, etc. I agree with you. On paper, your debt still sits on your book, but you still have the money in your pocket to deploy in other areas. So instead of having 90% of your capital tied up into a property that earns you an 8% yield, you can take that, invest that into launching 8-9 other hospitality opportunities that would earn you a 25% margin. That's the offering and the logic behind the fixed lease.
Yeah, I think what's been really interesting to see is in the last 10 years or so, you're seeing more and more generalist investors and institutional investors coming into the hotel space all around the world, because it's becoming a much more accepted asset class. And with that, most of the big institutional investors are becoming comfortable with management agreements. And the reality is, whenever you sign a lease, you're going to leave money on the table, because, of course, there needs to be a buffer for your tenants as well. So more and more of these big investors are becoming very comfortable with management agreements, because it also retains a lot more control about how you manage that relationship with the operator. And maybe both Ken and James, it would be good just to hear from you about what your views are and what you'd recommend from a debt and an ownership perspective that investors should look out for in management agreements.
Yeah, thanks, Sander. We're quite different to, obviously, Bevan and Grit, and I think it depends on the investor's appetite to absorb the volatility. It is a volatile sector, and obviously you're exposed to that with the management agreement, whereby you're obviously exposed to great potential upside as well as downside. So as an income investor, it obviously depends on your capital structure, how much debt you're willing to take on, your cost of equity, and your view, and as well as your relationship with the operator. HBF, as a business, we have a very close relationship with our operators, and we believe we extract value through that. It really depends on a few things when it comes to that argument.
And I guess from a management agreement, just commenting on what you're saying there, James, is it does place more responsibility onto the owner to asset manage and to work with the operator to maximize the value of the assets. And you guys have a big enough team to be able to do that, but as an individual owner, that may not always be as easy.
Correct. I think we work hard with the operator on the performance front, try and assist them where we can and work with them in terms of budgets and strategies and so forth. And then obviously with regards to the upkeep and CapEx spend. So keeping those assets relevant, positioning them correctly, and making sure they perform the best they can. So yeah, like you said, for individual owners it may be totally different. And it may be not that attractive and easy to deal with the management agreement.
Ken, you guys fund a lot of management agreements?
Yes, I mean, so as the IFC, I mean, we finance both equity and debt globally in emerging markets with varying, outcomes. Without sounding like an advertisement for the operators, we actually believe that management agreements with reputable operators are actually a healthy thing. A number of things they bring. They bring standards. They bring quality, where they are able to, in some cases they also bring things like food safety. So in emerging markets, I mean, these are extremely valuable assets that actually enhance the value of a hotel. That said, we also see the need for balance. So when we finance, even on the debt side, hotels that have management agreements, we look carefully at the pricing formulas around the management agreement. I think very often you have a percentage of gross operating profits plus turnover, and we make sure that, for example, the profit incentive is subordinated to repayment of the debt. So that we don't want a scenario where the operator does well even when the hotel isn't doing well. So we also look for alignment of interest between the operator. We actually see hotels as sort of really two businesses wrapped in one. You have almost like on the real estate side, you have a long-term asset that hopefully will appreciate in capital appreciation, the value on the property, and also has an annuity income. Whereas the operator's business is really an annuity business, which varies. But we believe reputable operators should be compensated fairly. Without them basically taking off everything before the hotel makes money.
Yeah, that's a great point. And I guess finding the balance in that management agreements that aligns interests, drives performance in line with the sort of asset management plan of the owners is pretty critical. And having worked with the IFC on a few of these sort of transactions, they certainly work hard with the owners to make sure that there's balance in that relationship. So that's great. We've got 15 minutes. I've got a bunch more questions about returns and deal structures, but are there any questions on the floor?
Thank you very much. My question is really a repetition of a question that I asked on the previous panel, and it relates to hotel financing. Donald, I'm from the Northern Cape, South Africa. I just wanted to test the appetite of the panel and also advise as to how should we, because we are just a small or an emerging, business that has acquired or offered to acquire land, in the proximity of an airport, and we have developed a business plan around it to build a hotel. We're looking at building a 145 room hotel, obviously with all other facilities. So I just wanted to find out to what extent or what should we do to be able to, to secure the necessary financing because obviously we have to build it from ground up. It's still just a business plan, and we now in the process of looking for financing.
I would say you start calling Zander. Can you hear me? You start by calling Zander, and he will perform a great feasibility study for you. No, but jokes apart, I mean, I don't know if someone wants to
I actually agree with you. Probably my first port of call would be to to go to a consultant of sorts that specializes in the hotel sector and get them to do a feasibility study. In parallel to that, you can reach out to operators that you think will be relevant and will be best placed for your hotel. If you get traction with those operators, they'll obviously do their homework and work with you to make the deal work. And yeah, coupled with a third party sort of giving the deal credibility from a feasibility side, then it's worth approaching a bank, getting them involved, and then it sort of rolls from there. So that's sort of my high-level suggestion.
Yeah, great question, and fully agreed. It wasn't planned that there was a free pitch for a feasibility study, but for sure, it's doing the homework right. I'd say speak early on to guys like IDC, who would be well placed for development like this. They've got a lot of experience, and they'll be able to share a lot of thoughts with you on that as well. Any other questions from the floor? Okay, well, whilst you're thinking, maybe just to talk a bit about target returns, starting with Bevan, because you're the most hard-nosed capitalist here. Talk us through what numbers are needed to get you excited about a deal.
8.5% in Mauritius. It's where the line stops. Look, I suppose from our perspective, our investment analysis starts always with what do we give back to our shareholders. So going into the various jurisdictions within Africa, it's very difficult to give a specific yield country by country because obviously each jurisdiction has its own tax laws, leakage, debt funding issues, forex risk, all of that needs to be priced into a transaction. Repatriation is a very big focus area for us. So my view is that from a returns perspective, as an equity investor, we would need to meet that minimum of an 8.5% return to our shareholders. Because of the specific nature of a hotel, I'll say we would probably want to include a little bit of a premium onto that. So our return on equity in Mauritius, in dollars, would be 9 to 9.5%.
Okay, and having done a few transactions together, I guess, it's all about doing the homework and figuring out what the bleed is along the way in terms of getting it to, a very tax-efficient jurisdiction and back out to shareholders. But I suppose you're sitting somewhere around the 7.5 to 9.5% yield mark across the continent. Is that kind of a range?
That is, yes, spot on. So, I mean, you're 100% right. Because of the nature of how we structure the fixed leases, like I said in the beginning, there's nothing sexy about how we position these deals. We have a certainty around a cash flow for the next 10 to 12 years. It's our ability to structure the back-end financing, leakage, tax, repatriation, all of that, which will ultimately provide an enhanced return to our shareholder. So yeah, 7.5 to 9% sounds about right.
Okay, great. James, you don't need to worry about tax, right? You're a REIT, so that makes life a bit easier. But what sort of returns do you target, and is it all about initial yield, or how do you look at life?
Yeah, it's sure. Yields, it's quite difficult in South Africa and Africa with not that many comparables and so forth. In efficient markets and transparent markets, usually hotels sit about 2% above prime commercial real estate, where it's a lot more difficult to button down here in Africa and South Africa. But rule of thumb, it obviously depends on the opportunity and the risk profile of that investment. But we'd like to sit at a stabilized yield of above 10.5%. And stabilization often takes place in year 2 or 3, depending on the asset, if we're acquiring something that needs to be repositioned or rebranded or invested in. So I think it's on a case-by-case basis, but our cost of funding is slightly less than most. So I'd see the individual hotel owner requiring a lot more than that in terms of a total forward yield return.
Okay, yeah, very interesting. And if you look at how that compares to stabilized yields of what the local REITs are buying commercial retail at, you're exactly targeting that 150 basis points, 200 basis points difference between the alternatives in the hotel sector versus the sectors. Any other questions on the floor? All right, let's see, everybody's ready to head out and have a drink quite soon. Really, one final question that I had, and maybe we can just get everybody's comment on it, but given where we are in the market today, if you'd be looking at a single investment in the hotel sector in sub-Saharan Africa, what would it be? What investment play would you be looking at today?
On the IFC side, I mean, we would, if we were to have that level of courage, we would be looking at a portfolio, targeting probably a portfolio within sort of Francophone Africa as a basket. We see a number of markets where there's opportunity for business hotels, limited services business hotels in primary and secondary cities. But we would look for a portfolio approach in cities where we believe one could get high occupancies and RevPARs. But we would be looking at probably an 8 to 12 year horizon if we were doing equity. On the debt side, similarly, we would be looking at projects that would, I mean, new builds will take probably 2 to 3 years to come on stream, another 2 years before you start making real money. So we would be taking a very long view, but it would definitely be a portfolio approach, not as a standalone single country.
Okay, great. I think our views are largely aligned, kind of the economy mid-market segment portfolio rollout with an opportunity to build a platform is certainly a great way to create value. Yeah, James?
Yeah, from our side, we 100% agree. In this economy within South Africa, the mid-market economy space is the space to play in. With an ADR sitting somewhere between, the 700 to 900 Rand mark, we believe there's growth and opportunity there. So, yeah, that would be my best bet, and yeah.
Great, Bevan. More resorts for you, or have you got a few other tricks up your sleeve?
No, so I would go with the obviously a brownfield portfolio in the Indian Ocean, operated by a single tenant backed by a globally listed parent company that would be willing to sign a 15-year lease. That sounds good.
Well, there's a bunch out there, so that's easy to
so
do.
many.
No worries.
So I would sign a lease, 25 years with Devan. No, jokes apart, I think definitely mid-scale eco is where seems to be the sector, the best segment to invest into Africa. I think in terms of risk reward, it's certainly one of the safest, less cyclical, less downwards risks, and clearly if you look at the offer on, especially branded offer in Africa. I was actually looking at the ratio the other day, and the comparison between Africa and the rest of the world. You can see it's nearly 60-70% of the supply, brand supply, on the upper segment. So I think that's where, for investor, definitely the clever move is. Yeah.
Okay, great. Any other questions? Right, then maybe just to quickly recap, I guess the general sense is that from a performance perspective, short-term, things are still relatively tough, especially in South Africa, in terms of the state of the economy and demand pulling back a bit. East Africa has been a bit tough, but West Africa, North Africa in particular, are showing some good trading numbers, as well as Indian Ocean, which has been a fantastic success story for the last few years and has got a really good outlook. And where we should be investing is probably through management contracts, so long as you manage them well, and so long as you get the right balance in place, a sensible capital structure, hopefully with the IFC that makes sense and has a longer term and longer investment horizon, and focus more on the eco and mid-scale sector rather than the top end of the market right now, which is probably a little bit more saturated and a little bit more volatile at the moment. So Yeah, please join me in just thanking the panel for some good thoughts on the sector.